There we
There we
go.
go.
Fantastic. So, so today is about getting ahead of the game. So it's all about maximising your tax allowances. We've obviously got a long time to do that because 5th of April 2025 is quite a few months away. But it's good to get on the front foot. So myself and Jenny want to talk to you from both of our angles because we work closely together. And we work via our networking group as well. That's how we know each other. And we thought it'd be a good idea to introduce clients that Jenny looks after and also myself. And then you'll be able to take it away from a company perspective, but also individual perspective as well about how these allowances can help you. In regards to question and answers, if I can just ask you to put any questions and questions, not answers, that'd be pointless.
We're supposed to give the answers.
Yeah, I think we are.
Yeah.
Yeah. So questions in the chat box, that would be much appreciated. Instead of everyone sort of shouting out questions. And what we'd do at the end or towards the end, we'd just look at those, and hopefully we can answer some of those questions that you have. So yeah, go on to the next slide, Jenna.
Technology.
There
There we go.
we go.
Right, so just a quick overview of what we're going to cover today. So first of all, we'll do a quick introduction of both of us for those of you that don't know us. We're then going to start with our focus on limited company owners and the most tax efficient way to extract the profits and cash within your business. We'll then move on to the more personal tax side of things and your investing allowances for this tax year. And then towards the end, given the big event that happened yesterday, we're going to give our thoughts on what we think might be happening with the Labour win yesterday in the election. So that's just our thoughts.
Yeah.
We don't know anything for sure as yet. So
Yeah,
watch this space.
don't take
But
it as gospel.
yeah. So first off, gonna go.
Yeah, why not? So those obviously don't know me. I'm Steve Ruane. My background is banking, mainly with HSBC back in the day, and I worked within their wealth management team and looked after premier clients. I've also got a background in lending as well, which I no longer do. But I have lent via companies and to individuals as well. And I've been with SJP, Frizzell Wealth Management, which is a practice of SJP. This is my 6th year now. And the service that I offer is bespoke. And the main areas I help clients with is retirement planning, is investing for the medium to long term, which is 5 years plus, estate planning, which is all around mitigating inheritance tax, and also protection, which is things like life cover, critical illness. And I do the protection for individuals, but also businesses as well, because they're two separate things. Okay, so that's a little bit about me.
Yeah. And so I'm Jenny. I run Nutshell Accounts, based over towards Whitney. So my background is I am a chartered accountant. So I trained in an audit firm in London. I then actually worked in-house in quite a lot of businesses in London throughout my career. I ended up at the BBC before I went on maternity leave. So I started Nutshell Accounts whilst on maternity leave about 5 years ago, and it's grown from there. So I work with small businesses, mostly limited companies, but some sole traders. And I help them with everything from sort of bookkeeping through to VAT returns, corporation tax, all those statutory reporting things, but also a little bit of what we're talking about today, which is your tax planning. So what's the most efficient way to structure your business and extract the money?
Yep,
Yeah.
good. Yep.
So let's just jump straight in. So this is, I suppose, my initial part of the webinar. So limited company owners and directors. So a lot of my clients fall into this bracket. So something that you will have heard me talk about or other people talk about a lot is whether to take your profits as dividends or as salary. So I'm sure lots of you have heard it might be best to take your sort of your personal allowance as salary and then the remainder as dividends. Now, these days, it's not always that straightforward. Okay, the government they've closed up a lot of the loopholes. It used to be that was the most tax efficient way, no brainer, just do it. Nowadays, they've closed it up, especially with the increase in the corporation tax rate, so that really, in many ways, it's often the same rate of tax that you end up paying overall. So there's other things that you should take into account. So I've put a few things here. There's things like, do you have any other employees who are not directors? Now, the reason I ask that is if you do, then if you're a small business, you will be able to make use of the employment allowance. And that means you have an allowance of £5,000 that you don't have to pay employers NI. So it's an extra £5,000 that you get each year. And that means that for those directors who have other employees, I normally say, yes, take your full personal allowance as salary, because you won't be paying any employers NI on that. But then that comes on to our next point, which is what's your wage bill expected to be? Because if it's expected to be quite high, if you've got a lot of employees, then you will be paying quite a significant amount of employers NI. So it's something to take into account. The third thing is, what do you expect your profits to be for the year? As you may know, the most recent tax changes are that there's now a corporation tax rate ranging from 19% up to 25%. And depending on where your profits are, it depends on what your corporation tax rate is going to be. So if you can do what you can to bring that corporation tax rate down to the 19%, for example, by reducing your profits to under 50K, it can be quite beneficial. And then this last point here is more on running your business. So you don't necessarily want to extract all of the money from your business. You might want to keep a certain amount of cash in the business in order to run it. So I often say you should really have at least 3 months of running costs within your business, for example, just in case you have a bad month on sales, for example, or you've got a big VAT bill coming up. You know, what do you need to keep in the business to keep that business running? Because cash is king. And if you run out of cash, what are you going to do? So I'm not going to spend too long on this particular slide, but this is just to illustrate really that it's not that straightforward, whether you should take dividends or salary. You know, this first scenario here is, you know, if you're expecting profits of up to £50,000, but you only have a single director, you don't have any employees, then you would probably take a director salary of about 9,100, which means that you're not paying any employers NI. Scenario 2 is, you know, maybe up to £100,000 of profit. So you're somewhere in between 19% and 25%, probably around 22% corporation tax. But you've got employees, and that means that you can pay yourself your full personal allowance. And then so on and so on. But what you can see is when you get into the much higher levels of profit, and therefore the amounts that you might want to extract, it really does become a bit of an academic exercise, really, as to whether you want to take dividends or salary. So one point I would make at this stage is, okay, the tax isn't likely to be that different. However, how good are you at planning for paying your tax bill? So I have some clients who I say to them, look, it's much easier for everyone involved if you just take your whole salary as salary. Take it through the payroll, you're paying your taxes as you go each month, everything's sorted. And then I have other clients who I know are super organized. They put that money aside as they pay themselves dividends each month. And, you know, then they can talk to someone like Steve to invest that money, for example. They gain some wealth on that money, and then they can pay their taxes in lump sums. So
makes sense.
Yeah, it's any questions on that, Steve?
Not me, no, all good. Yeah, I think a lot of our questions will come as we go through.
That's fine. So I'm not going to spend any more time on that. So then we come on to sort of other ways to extract your money from your limited company to be sort of tax efficient in a way using the allowances available to you.
Yeah, exactly. And we'll come on to what those allowances are in a mo. I guess I just want to touch on how I help businesses with extracting money from their limited companies. So, the obvious one is that pension contribution, and it's classed as an employer contribution. So you're extracting the money, putting it into a private pension, and ultimately the saviour is the corporation tax, as you well know.
Yes.
So what I do and how I help people is set those pension schemes up, give advice on how much you should be extracting, working with Jenny, who really is the person that should be saying this makes sense on how much you should be extracting, depending on the profit, right?
Yeah, and also actually on the amount that you have left in the company, there are times I refer clients through to you, for example, when they have built up quite a lot of cash reserves in the business over time, and then you can utilise those sort of allowances. Because one of the benefits is that because it's an employer contribution, you can utilise the maximum 60k.
Correct, yeah.
Rather than necessarily being limited by the amount that you're paying yourself in salary.
Yeah, totally right. So the 60k, right? We'll come on to that in a minute, and I'll bring in individuals, how it's different for individuals. The other areas that I think is an area that is becoming more important is protecting yourself as a director or directors. And I help people or businesses with setting up the right protection plans. So protection is obviously things like life cover, serious illness, sickness benefits. And it really is looking at, should we be doing it as via the limited company, or actually should we just be doing it as a personal protection plan? And a lot of it does depend on what your goals are and so forth, right?
Yeah, it does. The one thing I would say on that, so when I was considering whether to do it, I was like, am I intending to have my company forevermore? Well, actually, I don't know, hopefully, yes. But if you're not, then you might want to have a personal
one. Yeah, exactly. So it's my job to help you, I guess, understand what the future plan is of the business, and then should we actually be doing it as a limited company, or should we be doing it as just a personal plan? But things like relevant life insurance plans is obviously life cover within the business. Other protection plans that I come across quite a lot is if you're very reliant on a particular individual actually generating profit for the company, then it's really important that you get that person covered if something was to happen to them, because your profits could obviously be affected for a period of time if they weren't able to work for you. So there is something called key man cover, which I do a fair amount of as well. I would say, going on to the employee benefits, I do also help set up schemes or pension plans and protection plans for employees of the company. Okay, so an example is you may have a few employees that work for you, and you may want to give them the option of Nest, which is really sort of the standard plan. Or you could say, well, actually, a particular, it could be people that you feel are very important to your business, that you want to offer them something a bit more executive, like an executive pension. So you may want to look at setting up a different scheme that's not just Nest. So that's where I come in, where I can talk to the benefits of, should you be doing Nest? Should you actually be doing something that's got a little bit more ability to invest further, and the pros and sort of cons of that. So again, I help businesses set up pension schemes for employees.
Yes.
And also things like death in service. Yeah. It might be that you want to start offering, even if you've got 5 employees or whatever it may be, you may want to offer them death in service cover as a benefit, or to attract people to your actual business, right? Because if you're offering benefits, they're like, oh, well, that's good. It could be, I mean, you can do what you want. You could offer them critical illness.
I think as a small business, trying to recruit people, actually being competitive when you can't necessarily be as competitive on salary, if you can offer some good benefits, it can really help just build that package, but it also protects you as a business. So I think you were talking earlier about sort of sick pay cover as
That's
well.
Right. Yeah,
so it's a great benefit. Benefit for the employee, but it also helps you because you're covering that.
Precisely right. So instead of just offering statutory sick pay, you can offer them, like many bigger companies offer 6 months half pay and so forth, or 3 months, or whatever. So they're all stuff. That's all stuff that I do, and I look at for companies that want to set those schemes up for themselves as directors or director, and also for employees. And it is an important part of financial planning is protection.
And actually, just to jump in there,
Yeah,
Steve, because the point of all of these things is they're all allowable for corporation tax.
correct.
So as a business, you are investing in your business. Really, it should be seen as an investment, but you save that corporation tax on it.
Yeah, exactly. And the sort of final point I want to make there, point 3, is investing from your limited company. It's something I don't see that often. The sort of the obvious one for me is maximising your pension contributions as a limited company. But if you've kind of done that as a director or directors, then you've got a fair amount of money probably in that company. And I guess it's looking at what should you be doing with that money? Should you just be letting it sit there? Should you be putting it in a business account or business savings account and just leaving it in cash? But if you're really wanting to grow your business and maximise it and actually don't want to extract because you're already taxed on it, then there are ways of doing sort of corporate investments through the actual company when the aim is to generate growth on that money, which in turn will help support the business in the long term. And I say it's not something I come across every day because a lot of limited companies don't have that money to do it.
Often they might be, for example, they may have kept that money within the company because they have a big growth plan that will involve a lot of investment in, say, 2 to 5 years. So investing that in a sensible way, locking that money away for a certain length of time is a sensible way of maximising it.
Correct. Yeah. So again, that's something that I help clients with. But not necessarily something that comes across every day.
Not very often, no.
Okay, cool. Shall we go on to the next slide? I just wanted to touch on this. We were speaking about it earlier, and I thought it's quite relevant for people just to understand the importance of pension contributions, and I guess from an individual perspective as well, people that earn over 100,000 per year, as you can see on that slide. Every 100,000 or more, that tax-free personal allowance is reduced £1 for every £2 you earn, and then obviously when you start getting over the 125 kind of additional rate, it's kind of vanished. So a good way of trying to get back that annual allowance, that personal allowance, is to pay into a pension, because if you earn say 102,000 and you put your £3,000 in it and you're under the 100, you get your full personal allowance back. So it's quite straightforward financial planning, but people do, I think, forget as they start to earn more, implications can happen, and it's understanding what those implications are and what you can actually do. Example on the screen, obviously, if you earned 100 and got a bonus 10k, how that can actually affect you from a taxation point of view. So it's really important for both me and Jenny to help support higher earners in a tax efficient way with what they can do to help get that.
And plan for the future as well.
For the future.
So moving on from there, really, I think we're now going more into the personal.
The actual,
personal tax.
What we were talking about a little bit on pensions and the 60k.
So
this is a really important slide. I think people, individuals, businesses, to understand actually what allowances are available, and really this is what the webinar is about, is making sure you know what they are. For the first one, the savings allowance, and again you're going to take snippets away from the webinar, stuff you may already know, but hopefully you take bits where you don't know. I think what I see a lot of is people accumulating cash, and you do need cash. You need cash for emergencies. You need it, but if you're going to use it in the next 5 years, it probably needs to be in cash, realistically. But sometimes accumulating cash, it doesn't do you any favours from a tax point of view. So simply on there, if you are a basic rate taxpayer and you're getting more than £1,000 a year from interest, then you're going to start being taxed on that money, on that interest. A higher rate taxpayer, that's £500 interest, and then additional is zero. So it's really important, and it doesn't take a lot these days because cash rates have been higher than they've been for some time. So
it wasn't an issue until a few years ago.
No, exactly. And realistically, if you're a basic rate taxpayer and you've got more than 20,000 in cash, on average rate 5%, you're going to be starting to get taxed on that interest. If you're a higher rate taxpayer, that's 10 grand. And if you are saving for the future, or if you inherited some money and you're just leaving it sitting there, you are gonna start being taxed on it. So it's looking at other options available, I think.
Yeah, and I suppose there are options available, aren't there? If you still want to keep it in cash form and accessible, you can invest in ISAs. I know it's not ideal to take it out again,
Correct.
but
you can do cash ISAs. I mean, the two obvious ones are cash ISAs, because obviously the interest is tax-free. And the other one is premium bonds.
Yes.
All right. You're not guaranteed what you're going to get, but actually whatever you do win, or whatever that reward is, it's tax-free. So I always say to people, if you've got cash, just maximise your premium bonds, obviously 50,000 per individual. Maximise your ISA allowance, which you can see on the screen is 20,000 per person. And that's sufficient. But apart from that, if you're just leaving it laying around in a flexible savings account, it's not great. I'll come on to ISAs actually. I'll come back to pensions. ISA allowance, then we've touched on it. And as Jenny's just said, you've got cash ISAs, which again, you can fix them. You're going to get a better rate, but if you need that access,
sometimes it's worth it if you just want it for a short time.
That's exactly right. Well, whatever it is, or you can just leave it in accessible ones. Again, how high you help clients is more to do with what we've already spoken about is the future. So if someone comes to me and says, Steve, I want to invest some money with you for 2 years, then well, you need to be putting that in cash, because really everything I do is that 5-year plus. And stocks and shares ISA, you're going to get good growth on it if it's invested properly over a 5-year period of time compared to cash. So maximising your ISA allowance, put as much into an ISA as you can. If you can't do the 20k, do 10. It's available. If you husband and wife or partner, that's 40k. As an individual. And then I kind of want to follow into the JISA, which is the junior ISA. And sometimes this is forgotten. And I think it's a very good way of saving for. A good example is saving for education for children. University costs potentially. So you can put £9,000 a year per child into a junior ISA, and it could be grandparents doing it for grandchildren as well. But that's
is
really
the allowance per person, or is it per child?
Per child.
Yeah,
exactly. So the 20,000 is separate. Yes, 9,000. So that's good.
I think the point you made earlier, though, when we were talking about this, is that just remembering that when the child becomes 18, that money is theirs.
It is theirs. And it's a conversation I have a lot with people. Is well, little Johnny, hopefully you won't become a tearaway when he's 18, and hopefully he won't. But who knows, and I think it all depends on what you're saving for the child. There is a way around it. You can set up investments for children where you basically it's a designated account. So you invest in the same way as you would into a junior ISA, but actually you tell them when they're going to get the money. Okay, so it might not be till they're 23, 25. You are the owner, they're the beneficiary, but there's a bit more control there. The only downside is you can't do it as a JISA, right? As a
so you
junior
don't get
ISA.
the tax
It's not as tax efficient. There potentially is other, other elements to it. But again, if we mitigate it properly, and when you're taking the money out, we can hopefully reduce the tax you pay, if anything. But that is an option. Pension allowances.
So we've already touched on it, on the allowance of the 60,000 or 100% of earnings. I think actually the bit here that was interesting for me when I was talking to you this morning was the saving for children or grandchildren. I've never heard of this before.
No. So it's so going back to what you said, I'll come on to that. That's okay. But
of course.
Just to confirm, that 60,000, if you are director of a limited company, the potential is that you can put up to 60,000 into a pension. Doesn't matter how much you pay yourself via the limited company. It's classed as an employee contribution. And you can also, without going into too much detail, you can also go back previous years as well. So if you haven't contributed to pensions the previous years, there's a way of maybe going more than 60,000 if you're a limited company that's never paid in and you've got a big lump sum you want to pay in. And again, that's for me to advise. From a personal perspective, it's different. Okay, if you are a sole trader or if you are employed, the maximum you can put in plus tax relief is 100% of your earnings. Yeah. So if someone earning 20 grand a year, well, that is the maximum you can put into a pension. But it's kind of capped at 60k. So if you earn 60k, great. But if you earn 70, you can't necessarily put 70 in. Only if we go back to those previous allowances, which without confusing stuff.
And the 20,000, if you're earning 20,000 as an employee, is the 20,000 the employee and the employer contributions all together can only be
very important.
Yeah.
And that's something that, I have to work out for clients if they're wanting to contribute. I need to know, well, this is what's your employer scheme doing for you. That's the first thing I need to know. And what contributions go into it. So yeah, go back to what you said then, Jenny, about children, grandchildren, 3,600. It's something I don't come across every day, but I do have clients that are forward thinking. And what you can do, you can basically invest into a pension for your child, for your grandchild. So it's a third party contribution, but it's for their retirement, which seems quite crazy, but it's very good financial planning because you can put in 3,600 a year, okay, which isn't a huge amount, but that obviously includes tax relief as well. So it's maybe 2,000, whatever it is, 800. But if you do that every year, you're roughly going to have around 65k by the time I get to 18 that you've contributed, excluding the growth. And even if they didn't contribute until they retired, okay, be it late 50s, 60, that pot is going to be big.
Yeah.
And if it grows at 5 to 7% a year,
40 years to grow, hasn't it?
You're getting close to which we'll come on to later about the lifetime allowance, but you potentially could be getting close to that. So you're going to end up being a wealthy individual in retirement because your parents or grandparents, basically in the first 18 years of your life, paid 3,600 euros pension. So it's a school for thought. It is very forward planning. It's not for everyone.
It's unusual. I mean, I think most people want to plan for
the next 5
the next, well, or or education.
Yeah, education.
University,
I would say the whole ISA JISA thing I come across not daily but weekly for sure. The grandchildren pension stuff, a few a year maybe, but it's worth knowing.
Yeah,
and also it's worth knowing that actually if you were unemployed and you still wanted to pay into a pension. Yeah, because you were going through a period and you had some cash, you could pay into a pension.
Yeah.
And the maximum is 3,600.
Okay. Yeah. Moving on here.
So I don't want to touch. We spoke about this earlier, and inheritance tax is a subject for a webinar, I think, on its own.
Yeah.
Because it can be very
huge and complex.
There's lots to talk about. But I just wanted to touch on gifting. And again, something I advise clients on is you can gift as an individual 3,000 a year, which doesn't seem a lot, but I guess if you did it every year, or if you had partners, husband and wife, combined allowances is 6,000, and that would fall outside your estate upon death. So it's a useful tool if you can do it every year and it builds up. You can also carry forward 1 year. So potentially, if you haven't never gifted money to children, then you can gift 12,000 because you're carrying forward. Obviously, anything over and above that then falls into the 7-year ruling, which is for another day, really. But it's just maximising those allowances. I always recommend you note down when you are doing those gifts, and you obviously all of you have got wills, right? So you really want to, it's part of your estate planning, so you kind of need to be keeping it with the documents that are related to, unfortunately, death, but it's good noting on who you're gifting it to and when and the amounts. Anything on that?
No, I think that's we don't want to go into detail on inheritance tax today.
And the two allowances that have reduced in the last couple of months is the capital gains and the dividends to points that are dividends almost becoming pointless, but it's they've halved basically. So
comes back to what I was saying earlier, where the government are just trying to close up all those loopholes. But
correct. So again, me and Jenny see this maybe slightly different in avenues, but I look at how I look at capital gains tax is when I invest money for clients, it's more about we have to invest it in the most tax efficient way. And it's always generally maximise ISAs, maximise pensions. It's not rocket science on that. It really isn't. But actually, if you're over and above that and you're still investing money, then we obviously need to think about capital gains tax upon sale of the investment, right?
Yeah.
I put a couple of things there about transferring assets to your wife, your husband, your partner, if they haven't used their capital gains tax, and then that kind of becomes 6K. And you can split the sale of assets over years as well.
Yeah.
And I think easy wins, I guess, on that.
Yeah, and I think that was where it sort of comes in for me, because the way I see capital gains tax a lot of the time is more sale of businesses, where actually it's making sure as well that there are sort of reliefs available. So it used to be called entrepreneurs relief, it's now called business asset disposal relief, where so long as you own, this is really for family owned businesses or owner managed businesses, you can pay capital gains tax at 10% rather than the 28%. But it's making sure that everything is sort of set up and structured correctly to make sure that that will be the case when you come to sell your business, should you wish to. But then, you say here, split the sale of assets over years, whether you sort of sell part of the business to begin with and then sell another part later. So do it gradually over the years to maximise your allowances as well is something worth considering.
Totally. I think the sort of the conclusion on capital gains tax is very hard to avoid not to pay.
Yes, you will always end up having to pay some, but it's how can we mitigate it? Yeah,
exactly. Dividend allowance again. Jenny will see this differently because she deals with people that pay this as well dividends. I'm more concerned about people that want to generate income from investments, and again, if you can build up your ISA pot to a nice amount of money and you want to start generating an income from that ISA pot, it's always going to be tax free. There's not going to be any tax to pay at all. So a simple, simply if you had some money and you invested 20K for 5 years, you had 100,000 plus growth, and you wanted to start to take a percentage of that as income, it's tax free. There's never going to be income tax, capital gains tax. So again, utilise those ISA and pension allowances. And instead of, people do like to hold single shares. People, like to dabble in that kind of area, but you obviously need to be aware if you're holding single shares of a company upon sale or upon dividends, if you're getting payments from those, you're going to got £500, which isn't a huge amount of money. So again, a simple way is go back to those ISAs and pensions for me. Anything you want to add on dividend allowances?
No, I think
so
we've talked about dividends. No, I mean, let's face it, it's been halving every year for the last 5 years, I think. So I think it's probably going to be gone soon. Wouldn't surprise me.
Yeah. Got some cherry.
Yeah, sorry. Right. And then on that note, coming on to, I suppose, it's very topical, the general election yesterday, big landslide win for Labour. And we just wanted to give a few thoughts about what might happen. This is very much our thoughts. Nothing has been announced as yet. But I suppose these are our initial thoughts. Labour haven't actually said very much on the main taxes. So income tax, national insurance and VAT.
No, I think what we agreed is, well, again, it's only our thoughts, but it's probably going to be fairly.
I think they've been very careful, I think, around this. They just keeping it all fairly steady, I think. The big thing really is the thing at the bottom here. The big policy that they've come out with to increase the tax to be able to afford all of their plans. I think they're planning to tax the wealthy in other ways. So, VAT on school fees is the big one. But they're also talking about reducing the business tax relief for private schools as well, both of which will have a big knock-on effect should you have your children in a private school.
Agreed. Yeah, it's a big uplift. So, I can't say if it's going to be likely or not, but the talk on VAT on schools, I totally agree, on school fees is definitely one for topic. I, I kind of think if we look at all of the available ways of increasing, the one for me is capital gains tax.
Yes.
Personally, again, please don't take my word for it.
They haven't actually announced anything
They
specific on capital gains, so there's a lot of chat around
a lot
it.
of chat,
Yeah.
and I don't want to scare people, and they're not going to sleep tonight. But so again, please don't do that. But I kind of think it's one of those where they can look at trying to do something around them. Only stuff that we were talking about earlier, what I've kind of looked on ways they could do this is it could be on residential property, which would be a nightmare. But it could be that you get capital gains tax, not necessarily on your second home, it could be on your main home, right? The other one we spoke about was the actual capital gains tax being paid is being put in line with your income and what you actually pay from an income tax perspective.
Yes.
So if you're 20%, maybe 20% capital gains tax, 40/40. I kind of think that, I don't know. I think that may well be an easy way of them raising money. But again, it's all stuff that I've, from my education as an advisor and what I read, things that could happen. I did make some more. Let me just check.
I
did make some more notes. I'm missing there. They're the main ones. Yeah, so selling the business assets, don't sell assets. But yeah, I mean, I think we did talk about this actually. It's a really good point for business owners. If you're obviously selling business assets and you're going to get capital gains on it, if you don't really need to sell the asset, you don't need to sell, then don't.
I suppose is this sort of assets that you're holding within the business and you might want to sell them to raise money.
Correct.
So rather than selling it, you could raise money against it. You know, there are good business
you
loans
could raise
and
money
out there
against
at the
the
moment.
asset instead of almost selling it to then gain capital gains tax. Again, it's just a thought process really on how that would work. But ultimately, you know, to try and avoid capital gains tax, it's really just making the most of what you can invest in where you know there's not going to be any. And obviously for many people, this is not possible, particularly business owners.
Business owners, it's impossible. And you have to hope that they won't do away with the business asset disposal relief, but they might look at it. I mean, who knows?
I know.
Who knows?
Another things that we also mentioned that I see is inheritance tax. So sort of having a little think about it. And again, as I mentioned earlier, it is a big area, inheritance tax. But at the moment, if you're a joint couple, you got £1 million really to play with regards to your estate, because you've got your 325. And those that don't know, you've got something called a residential nil rate band, which is 175 per person. So that takes up to 500. But that residential nil rate band is obviously looking at second death. If your family's inheriting it, if your children, your grandchildren, then that nil rate band is being neutralised. And most of the time, it is.
I suppose just to clarify there, because I didn't know what this was earlier today when we spoke, the residential band is for the actual property, if it's the main home where you are living. If that's then passed on down, you get that additional
grandchildren,
175,000.
Exactly. So majority of the time, the states are £1 million on joint, 500 on soles. I kind of think a quick win maybe is to take away that residential. So that will automatically then, you know, sort of take it down to 650 as a joint couple instead of £1 million. And then you're going to have even more implications, because living in the southeast with property prices and having a bit of spare cash, you could easily go over that 650, and a lot of people actually go over the £1 million around southeast. So again, school, it's a thought process, and as an advisor, I guess it's how I think what they could do to potentially to try and raise a bit more money. It could be they change the thresholds available in inheritance tax and scrap that residential nil rate band. This was an interesting one about the business relief within families passing it within companies.
The inheritance tax. Yeah, again, it wasn't someone I was aware of, which is why I work with you, Steve. Inheritance tax on companies. So if you pass a family business on to your children, there's no inheritance tax.
Yeah, you get 100% relief. So it has to be unlisted.
It needs to be a limited company, unlisted.
Yeah. So if you're passing on the company or shares to family members, then upon death, there's no IHT. And again, if they scrap that could become
that will hurt lots
an
of
easy
family
win
businesses.
for a lot of family businesses.
Yes.
And again, as I said, I don't necessarily say they're going to do this. I'm thinking outside the box of ways they could generate it, but I guess we're not going to know until
in the next few weeks. I mean, I think things will start to become clearer.
Yeah.
I suppose should we just touch on pensions as well there?
Yeah, so pensions was the other one on my list that we spoke about. And I guess the one that Labour did originally say, so at the moment, for those that don't know, there's something called a lifetime allowance, which no longer exists because it got abolished in April. So the new tax year. So at the moment, you can go crazy on your pension. For those that want to save more than £1 million into a pension, you can. Okay, and it's okay. There's no tax charges. There's I kind of think though, realistically, Labour did say they would bring that back a few months ago. So again, you don't really want to be having any more than £1 million in a pension because it's not really tax efficient. But then I was reading the other day that they may actually go back on that and keep it as it is. So I don't know, but I think people that maybe do have big pension pots, they just need to be cautious that, if you do start going over £1 million and they do bring it back, I don't know what the implications would be.
No, you don't know whether they'd retrospectively apply it. If you've already got that, then it seems, I
don't know. Regards to state pension, I think they basically said triple lock will stay. So state pensions will sort of be going up with regards to inflation and other ways. And as we know, people that are in state pension, they get a yearly pay increase. But again, how far can that actually go? I think there are a lot, again, state pension, we'll talk about that for a long time. There's obviously issues with the state pension and how long that physically can be maintained and so forth. Hence why saving into private pensions is really important. But there was a stat I got. Remember I brought that stat up?
Yeah.
Which I thought was useful sharing. So the stat is that sole traders, only 23% of sole traders actually have enough in a pension pot to kind of leave a moderate retirement, which just shows, I think, for people that are self-employed, it is an area that sometimes can.
I think it's very easy to forget.
I agree.
I think it's very easy to forget when you first start up your business.
Yeah.
You may well have come from employment where you had an employer scheme. And I know myself, when I started the business, it wasn't top of my priorities. I thought I could wait a couple of years, which I did until, the cash flow was there. But then I started investing from my limited company. I think for many sole traders, they're running on their profits and, investing in a pension is one of those things, isn't it? It takes cash flow away from now. So you've
got to do it
you've got to do it at the right time.
At the right time.
If you need the money now, you need the money now.
And I appreciate that. Someone just starting off on their own, I wouldn't be saying, let's go for it and kind of give it
I think that's where this stat as well, because I said to you earlier as well, didn't I, that actually a lot of sole traders, if they're running as a sole trader structure, they're likely to be quite small, maybe at the early stages, because once they hit that sort of higher tax bracket around the 50k mark of profit, it makes much more sense for them to then incorporate and manage their tax that way, and then they get taken out of that stat. So
agreed. Agreed. I kind of think we're coming towards the end of the webinar, so we'll come on to questions in a minute, but just one other point I just wanted to point out was about people that maybe have a limited company and they're thinking they want an exit strategy. So they want to look at what would it look like if I sell my business in 5 or 6 years, and capital gains tax on that. I mean, go back to what we said. It's hard not to pay capital gains tax if you're selling your business, but it's really useful to know that there are, not me personally, but I do work with business sort of strategists that support limited companies in how to exit businesses efficiently and how they should do it. And it is an area that, again, we could talk about for a long time. But if you're ever thinking about exiting from a business, be it, I always say forward plan. I always say you want to be getting on the right foot 5 or 6 years before you even were to do that. And it's being introduced to the right people to actually support you during that challenging time, even though it can be exciting if obviously, you're selling your business and getting the rewards for it, but it really needs to be done properly. So get on the front foot, I would say.
Yeah, I think my advice, I mean, I know I'm biased, but I would always say talk to your accountant as a first port of call.
You're totally right.
And your accountant will put you in touch with the people that you need to talk with.
Yeah, and I would probably always go that route. Are you with me?
Yeah.
The same way? I always say it's a bit like extracting pensions. I say, this is what I think you should do, but actually, before we press that button, just confirm it with your accountant.
Yeah.
Makes sense?
Yeah, absolutely.
Bonus.
Right. So I think now we're on to any questions.
Yeah.
So I think I did see some things coming in.
So we'll see.
Let's have a little look at the chat. Okay. So
yeah,
can you take that
lifetime
one?
ISAs. I mean, I'll be honest with you, with lifetime ISAs, I personally don't get involved with lifetime ISAs because it's more to do with it's not quite, even though it's for the future, wealth management companies only deal with what's called stocks and shares ISAs. So with regards to lifetime ISAs, it's not my key area that I deal with. But what I would say, so it's the Blue Tree Company. So is maybe if we speak offline, I can help you look more into it. Yeah, I can give you a bit more info on how it looks, and I probably would like to say these are the options, these are the benefits of a LISA, these are the benefits of stocks and shares and cash, and you can decide for your own. But personally, doing wealth management, the only real ISA that I get involved in is what we call an investment ISA or stocks and shares.
Okay. But you can probably put Fred in touch with the right people.
I can definitely do that. Yeah. So perfect. Happy to help there.
And then I think Lucy says, is gifting only for your own children, or can it be for anyone?
Yeah. So no, the 3,000 is gifting to whoever. It's just important that you obviously know who you're gifting the money to. The business is slightly different, as in how you inherit the business via family business. You can't just give it to next to over. But as long as you're making a note of it, obviously anything over that £3,000 is classed as falling inside your estate still for that 7 years. But yeah, no, you can gift to them.
I think we've covered capital gains tax and what we think Labour might do to it. I think we've covered that now. Hopefully.
Yeah.
Well, that came before we started talking about it.
I hope so. Yeah. Again, they're only thoughts. So.
Yeah, but oh goodness.
Yeah, give us time to read this one.
Okay, so Phil, on the R&D tax relief, I think that's one that we should talk about probably offline, because it's very specific to what you have been doing. R&D tax credits is not an area that I do myself, but I have various contacts, much like Steve was talking about with the life ISAs, that can help. And the only thing I'd say on R&D at the moment is that the HMRC are clamping down quite a lot on it. You know that there are lots of businesses out there who will just tell you they definitely can do it. And then, you know, you put in the claim, you might get it, and then HMRC investigate it and it gets taken back. So you have to be very careful. But, you know, up front, yes, I think if you're doing something that is research and development, creating something new, which I think you are, Phil, we should definitely investigate that and get some R&D tax credits for you. So let's talk offline on that.
Okay, cool. I think that's the questions at the moment, isn't it?
Yeah, unless anyone has any other questions, please pop them in the chat.
We'll give you maybe
a couple of minutes, but otherwise, I think
we can go to the last slide then, can't we?
Yeah. Otherwise, I think that is everything. So here we go. So, I mean, Steve and I have both sort of said, you know, there might be specific things you might want to get in touch with us about. If you have any other questions on anything, those are our email addresses. You should have our contact details in any case, or one of us. So if you need to get in touch with the other, just ask.
Yeah, please reach out.
But yes, thank you.
Thank you very much. I hope you enjoyed it. I hope you can take some bits away from it, and hopefully we'll see you all very soon. Perfect. Thanks, everyone.
Thanks, everyone.
Thank you. Cheers.
Right, I've got to
stop recording.